Today we are diving deep into one of the biggest, and I mean biggest, shifts happening in finance right now, the tokenization of real-world assets, or RWAs. And look, forget the buzzwords for a second. What we're really talking about is fundamentally rewiring how capital markets work, how we own things, how we trade things, everything from skyscrapers to private credit. We're at this incredible moment, moving past niche crypto experiments and into full-blown institutional adoption. So let's get right into what that actually means.
So just to wrap your head around the scale we're talking about, look at this number, $30.1 trillion. That's the size the market for tokenized real-world assets is projected to hit by 2034, according to a report from Standard Chartered and Simpulse. This isn't some small corner of the market. This is the future of finance being built brick by brick right in front of us.
All right, so what is asset tokenization anyway? Well, at its core, it's pretty simple. It's the process of taking the ownership rights of a real-world asset, think a building, a bond, a piece of art, and turning them into digital tokens on a blockchain. So imagine a huge skyscraper. You can't exactly chop it up and sell pieces of it, right? But with tokenization, you can. You can create, say, 1 million digital shares of that building. Each token is like a digital deed, a legally backed claim to a tiny piece of that property. And just like that, a traditionally illiquid asset becomes divisible, tradable, 24/7. Now, to really grasp where RWAs are headed, you've got to understand where they came from. And believe it or not, the past year is surprisingly recent. So let's trace that journey, from a pretty niche concept to a technology that is now being embraced by the absolute giants of finance. Because honestly, the acceleration is the real story here. What's just wild to me is the sheer speed of this. Back in 2018, tokenizing a single resort was this groundbreaking, almost experimental thing. Fast forward to today, and you've got giants like HSBC offering gold tokens directly to retail customers. This year alone, Goldman Sachs and BNY Mellon are getting in on the action with tokenized money market funds. And BlackRock's fund? It's already being used as collateral in the DeFi ecosystem. You know, that whole world of financial apps built on the blockchain. The pace is just a massive signal of where this industry is going. This quote from the IMF, it just perfectly nails the why behind all this momentum. I mean, why are these huge institutions suddenly so interested? It's because tokenization isn't just about creating shiny new products. It's about fixing the old clunky plumbing of the financial system. It's about tackling these inefficiencies that have existed for decades in how assets are issued, settled, and traded.
So with that why in mind, let's pop the hood and take a look at this new financial plumbing that's being built. We're going to break down the core tech, the different ways these assets are being put together, and importantly, the major hurdles that are still standing in the way of this going completely mainstream.
Okay, this is a really crucial distinction for anyone trying to understand this space, the difference between digital native and digital twin models. A digital native asset is basically born on the blockchain. It never existed anywhere else. This is where you get all the promised benefits of the technology. A digital twin, on the other hand, is what we see most of today. It's a token that represents an existing off-chain asset, like a bar of gold sitting in a vault or a property deed filed away in a registry. The token acts as a kind of digital claim check on that real-world thing.
But, this transition isn't all smooth sailing. Not by a long shot. Regulators like ISCO have pointed out some really serious hurdles. You've got the classic operational risks, right? Bugs in the smart contracts. That's the code that runs all this, or cyber attacks. You've also got this fragmentation problem, where different blockchains don't talk to each other, so you just end up with new digital silos. And then there are the big ones, regulatory confusion, the so-called oracle problem, which is this fundamental puzzle of how a blockchain can trust data from the outside world, and the absolute cornerstone of it all, legal enforceability. So, with these huge challenges around trust and data, how do you actually build a system that works? Well, one of the most fascinating solutions emerging is the integration of AI. The idea is to use these autonomous AI agents to basically oversee the entire process, enforcing rules and verifying data without needing a human to step in. And here's what that could actually look like in practice. Just picture this for a second. An AI agent instantly pings a government land registry to confirm a property deed is legit. Another AI model crunches live market data to give you a real-time, unbiased valuation. A third agent handles all the compliance stuff automatically, and a fourth is just constantly scanning for any funny business, like fraud. This kind of AI governance layer could be a game changer for automating trust and slashing risk. All right, so now that we've gone through the tech and its challenges, let's look ahead. What does the future market for all these tokenized assets really look like? And maybe more importantly, where is the institutional money already starting to flow?
I mean, look at this. The range of projections from major analysts is just staggering. And yeah, the specific numbers are kind of all over the map, from 2 trillion to over 30 trillion. But that's not really the point. The point is the direction. Every single major institution looking at this space sees massive, multi-trillion-dollar growth just over the horizon. The consensus is undeniable.
And hey, this isn't just some speculative forecast. This isn't just theory. Real-world adoption is already here, right now. Just look at this chart. The issuance of tokenized fixed income products is seeing exponential growth, especially in places like Europe and Asia. This has moved way beyond the pilot program stage. This is the market in action.
So, where's this growth going to come from first? Well, a recent State Street survey of institutional investors gives us a super clear answer. They are looking squarely at private, illiquid assets. 63% think private equity is going to be first, followed right behind by private fixed income. The big focus is on unlocking liquidity in these markets that have for a long time been really hard for most people to get into.
So what's the real business case here? What's driving this whole shift? It's not just about getting access to new assets. That same survey shows it's about making fundamental improvements to the system. Better transparency, faster trading, and lower costs for compliance. In short, it's about making the entire financial system more efficient, more secure, and ultimately a lot more cost-effective.
Okay, we've covered a ton of ground, the history, the tech, the outlook for the future, but all of this brings us to what I think is the single most important takeaway for anyone, and I mean anyone looking at an RWA project.
It all boils down to this one critical question, and you have to ask it for any project in this space. How specifically is the digital token on the blockchain legally and operationally bound to the real-world asset? You need to get into the weeds here. What is the precise legal structure? What is the technical framework that guarantees these two things are inseparable? Because if that link is weak, you could end up holding a token that is little more than an empty digital promise.
And that is why this one question matters so much. Because without that unbreakable link, a token is just a digital promise. It's not a digital asset.
This is not financial advice.